Uh-oh. Are we on? There we go. Let me see. Okay, is my screen being shared? Let's see. There we go. Sorry about that. I'm having a little bit technical difficulties. Are we on now? Oh, good. Sorry about that. So I was looking at Tesla. All right, so I'm going to be talking about option spreads today and the different kinds of spreads we can open and just different option strategies for everybody. A lot of people, when they start trading options, they're completely overwhelmed, or they get in something that they think is, going to be great, or, you know, it's a swing, but it turned into a day trade or something, and oh, I'm out of day trades. Whatever the case is, you can lose a lot of money really fast in options, and I know this because I've done it myself. So, when I do option spreads, a lot of times I'm doing it with the intent on swinging them, almost always, and usually they're several days or a month out. So if you are someone that's new to the open house or new to Penny Boys and you're here for the first time for the open house, or you've kind of just been paper trading, or you're not really sure, where you want to go with your options trading, um, there are a lot of different strategies. And if you've tried just the regular calls and puts, and you're getting frustrated with the fact that um, you've bought a call, for example, and let's say you're swinging it and the stock really isn't moving in the direction you want. And let's say it's not even going the opposite way. It's like, oh, I'm in a call when I should have been in a put. A lot of times this has happened to me a lot, and it's happened just in general. If you don't get out soon enough, or if you're still waiting and hoping that the stock is gonna, skyrocket or do whatever the direction that you're wanting it to go. If it's not doing that and it's just kind of sitting there going sideways, like for example, let's say you were in this week for right here for Apple. Just this is just an example because I'm looking at it. So, we kept kind of bouncing off this support line here, and it really didn't go above this next resistance line. So it's trading in this really, really tight range. So when it's doing that and you're not really getting a, bullish movement, a really, strong movement to the upside or a strong movement to the downside, if you're in a naked call that's, up here, like let's say you were in like a 160 call and you got in it like on this big green candle on the daily chart. So if you had that and you kept holding it and kept holding it, and the stock is going sideways, what's going to happen to those calls? You're going to lose money, and you're going to lose money on the put side too, because it's trading in this really small range. And this is especially good for people that are working during the day and you don't really have time to just stare at the charts all day. If you are in a spread, whether it's a bullish spread or a bearish spread, or if it's a credit spread or a debit spread, you don't really have to watch it all day, every day. So you can kind of take a break and, do other things. You just have your alert set. You can, kind of check on it from time to time. It's just really good for people that are, busier. They don't really have time to just sit there and stare at the charts all day. Or if you have a really busy personal life or something, if you don't have time, you're just it's something that you're not super interested in, but you still want to make that passive income, or you still want to be in a play, but you don't really have time to just scalp all day every day, because that can be really time consuming. It is fun to do, but if it's not going your way, or if it's just something that's really frustrating, um, I like to open, spreads on options. So I'll just go through a couple of examples of how I like to do this. I can open Robinhood, but, let me see if I should. Let me see something. So, let's see. Yeah, this is okay. So, let me see if I could drag this over. Hold on a second. I'm not sure if I can. Yeah. Okay, so as you can see, this is a small account on Robinhood. Let me see. So let's say you're looking at Apple calls, like I was looking at earlier, because we did bounce off that support around 130, and it's really holding that level. It's been holding that for a while. Let me go back actually. With that. So I've been looking at this for a long time. I've had this lined up for a very long time. Um, it's been retesting this just a few times since like last year, middle of last year, and we did get that bounce off here, and Bull made a beautiful play on this one. And I do like that, Ed. It did come back down, and it did test this, and came right back up. I mean, this is absolutely beautiful. So let's say that you this is not, you know, completely a recommendation. It's just something I'm looking at. So let's say that you do expect Apple to come back at, whether it's now or later on after we, reclaim this 9 EMA on the daily chart. Let's say you're expecting it to at least test maybe this level, like the upper 140s, maybe up to this next one, like 150 within the next couple of months. It obviously it's not going to do it today. I mean, unless something wild happens, but you never know. But let's just say, within the next couple months, because, this was back in November. We're in December now. We're nearing the end of December. So let's say in the next couple of months, you are expecting Apple, for example. This could be any stock, by the way, obviously, any stock that has options on it. So let's say that you're expecting this to kind of come back up and reclaim, or at least test this level up here in the high 140s, maybe low 150s. So let me go back. Hold on. Okay. So I'm looking at the February expiration cycle for Apple calls. So this is still a very bullish strategy. It's not a neutral strategy, and I'll go over those in a little bit. But for right now, let's look at a bullish strategy. So let's say that you're looking at this, 145 call. This looks pretty good. It's up 28% today, but that's because we came back down. We are up about $5 from yesterday. So I do like this. So let's say, yeah, we want to buy it. Plus, Apple, I believe, reports earnings in early February. So this probably has a good chance of coming up here. So you say you want to buy this. Well, since I have a small account, I don't have enough to buy this call. Let me go back to Discord. Hold on. Hold on. This is a little slow. There we go. Okay, so let's say that we're looking at this 145 call for February, and that's a good expiration date, because we got a couple months of time on it, and if we do get that Santa rally or the beginning of the year rally, that's really good. Well, since I have a small account, I can't really afford this right now, right? So let's say we want to buy this, but we want to remain in a bullish play. So, okay, here's a 150 call. What I can do is I can sell this one, and that's going to bring my cost basis down to only, $150 as opposed to 390. So you can still remain in this bullish play. Like if one of us alerted, you know, uh, a long swing on Apple, and it's something that you really can't afford, or if it's a leap, or if it's just something you don't want to bog down your portfolio with, um, you can always do a spread on this, and there's all kinds of different spreads. I'm just going to go over just basics. So from time to time, we will alert spreads on this, along with the just the regular long option. So if it's something that, see, it's already coming up. It came up for a second. So you can do something like this. If we alert something like this, now you do have to have a margin account for these, and usually if you just had opened a Robinhood account, it defaults to a margin account, and that doesn't mean that you have to use margin. Okay, sorry, I'm looking at the chat. That doesn't mean that you have to use margin, meaning like it doesn't mean that you have to borrow money in order to open these plays. It just means that it's not a cash account. So you are subjected to the pattern day trade rules when you have a regular margin account, like what Robinhood defaults to. You can make a margin account on Webull, but you have to make sure that you have level 3 options enabled. So level 3. That's really important, because if you only have a level 1 or 2, you can sell options, but you cannot do spreads. It will not let you do vertical spreads, but you can do some of the passive income techniques that Bull was talking about. Just a second. So, so these are good for, smaller accounts, or if it's a play that you're not totally sure about, but, you want to get a piece of it, you can most definitely open a spread on this. So plus it's going to reduce your cost basis. It's also going to reduce your exposure. So let's say that it is starting to come up, and like Apple's starting to do a spread. I'm going to just answer questions as I'm going, because, yes, all spreads require level 3, because, okay, so level 3 involves the buying and selling of options at the same time. So you are going to need level 3 enabled for that. And that goes for vertical spreads or calendar spreads, or some of these wild, iron condors or butterflies and all this extra stuff that goes, we don't talk about that until like when you're in the Penny Boys Advanced section, but that's something that you can definitely learn along the way. But level 3, if you do want to just open the regular vertical spreads, which is almost all of my alerts are vertical spreads. So unless it's sometimes I alert calendar spreads, and we'll get to that later, just touch on it a little bit. But, spreads are good for just reducing your exposure. And, I, even though it is kind of an advanced technique, I do like them for, beginners, or for somebody that has, not a huge account. I don't work with giant accounts, so it can just, reduce your exposure, reduce your, I guess, risk, you could say, in a way. But anytime you're dealing with options, it's going to be risky. So, take that for what it is. But, if you have a smaller account, you don't want to put up almost $400 for an option. I completely understand, especially since this is a longer swing. You're probably going to be holding this a while. So if you only have, like, a few $1,000s in your account, you know, $400 is going to be a big chunk of your overall account. So it's not something that a lot of people would want to just, oh yeah, I'm going to take, 40% or 20% of my account and just, let it sit here. Especially if you're trying to day trade also, because these are going to take up some collateral, or some capital rather, or it'll take up collateral if we're doing, a credit spread. But in this case, you can reduce your cost basis, and instead of $395, you're only going to be paying $150. Now, with that cost basis reduced, you are also capping your gains. So that's something that if you're extremely bullish on Apple, for example, this might not be the play for you, because let's say we decide to hold this through earnings. We're just hypothetical here. So hypothetically, let's say we hold this through earnings, and Apple goes up to 160. All right. So if you were holding this 145 call, that would be worth about, let's see, $15, or a little more maybe, depending on, I'm not 100% sure when Apple's earnings are. I think it's the first week of February, but I'm not 100%. So this would be worth a lot more money, because these are going to be deep in the money at that point, right? So the most that this spread that I just was discussing can be worth at expiration is going to be only $5. I mean, only $5 is still, a tremendous gain, over 100%. But, coulda, woulda, shoulda, you would have made more money had you held, if Apple came up to 160, for example. It's just hypothetical. So it's kind of like, the just risk reward. I mean, how much are you willing to risk to get whatever reward? Okay. So does that make sense when we're talking about reducing cost basis and things like that when it comes to debit spreads? So this is called a debit spread. This is when you're basically just in a bullish play, you're just reducing your cost basis, or a bearish play. We can do the opposite. I'll just show you how it looks. So let's say you're bearish on Tesla. This is just an example. It's not a recommendation. Just kind of going over what I like to look at. So let's say that Apple did break support and we're coming down to the 120s area ish. Yeah, there's the ish. Okay. So instead of buying this one just as by itself, you can sell one down here. So you're remaining in this bullish play with your buy strike closer to the money or closer to whatever the stock is trading at the time. So, for puts, it's going to be the one above, and for calls, it's going to be the one like below. If this was a call, like it'd be right here, as opposed to, selling this one or buying this one and selling this one, for example. So that's how debit spreads work in a nutshell. So as you can see, that's a lot cheaper, 80 cents as opposed to $2.46. Okay. So and I also like Robinhood because it always tells you what you're entering. So you don't have to worry about, oh, did I get the strikes mixed up or whatever. It's going to tell you right there. So let me see something. Okay. Let's see. So, it is kind of holding up there. Let's see what AMD is doing. Yeah, I had this line drawn for a bit. Here when it gapped up back in July 2020. We did consolidate here and come up, and this is one that I thought was gonna go a little farther than that, but it did hit the support down here and it came back up. So I'm not sure that I'm going to enter something right here, but if I were, it would be far out expiration wise if I'm going to enter options on this. So let's go back and talk about, let's see. So those are just some examples of some plays that we alert in here. If you're someone that, you don't think that you can trade options because you don't have a large account, or if it's something where, okay, maybe you do have a larger account, but you don't have a lot of time to just sit and stare at the charts all day, or you don't want to, or for whatever reason, we do alert those smaller and slower moving kind of plays. But my favorite type of alert let's see. This is what I like to alert. Let me take a look here. So Bull actually alerted one of these on Apple, I believe. And I don't remember what strikes it was, but I'm just going to make one up right now. So if you're, let's see. So let me just go back. Let's see. Okay. So I do like this 130 level for support. I've been looking at this for a bit. So if you want to be safer and, oh wait, here's the earnings. Okay, it's at the end of January. So that would have been just fine. Okay, so if you want to be, pretty safe, because this does kind of go a little bit below 130, but, I don't think we're going to see, if that does break. Yeah, so we got like another level, like about right there, like about the 125 area. If it did break that, then, you would have to obviously exit the play, just like, we would say, regardless. It doesn't matter if it's a spread or if it's a regular call or if it's even an equity play. If it's breaking your support levels and you're still in, you're still in a bullish play, you just need to cut your losses and get out, because it's not worth just waiting for it to, come back. Because if you're in a credit spread play where you need collateral, you're going to end up losing all of your collateral if you just hold it and do absolutely nothing. there are ways of getting out of these plays. And if you are in the premium section, that we can guide you in how to get out of those plays. We call it like legging out of plays. And, a, a lot of times you do need a little bit more than what you're putting in. You need a little bit more to be able to buy back one of those options. Your sell option. If you need to buy that back, you're going to need some of that money on standby to be able to buy that back, so you can comfortably leg out of that play and be able to stay in your long position, your long put or your long call, whatever. Yeah, your long option. So for a credit spread play, it's basically the opposite, but also very similar to what a debit spread. So let's see. Let me try to explain this the best way I can. So for a debit spread, you just need to do like what I was describing a minute ago. You just need to be able to buy an option just like you would be if you were just buying a regular call or put. But at the same time, you're selling one to reduce your cost basis. So this is a $1 wide or a $5 wide, $5 wide strikes. So 155 minus 150 is 5, right? So this is a $5 wide spread. So for a $5 wide debit spread, we could buy this one. I don't know, I think I was doing this one. Yeah. Buy this one, sell this one. So you're in essence reducing your cost basis. Yeah. So instead of $3.95, you're going to be paying about like $150. So that's pretty self-explanatory. You're only paying for, what you're paying for. That's as much as you can lose. Just like buying any call or any put, however much you spend, that's the most you can lose. You can't lose any more than that. So with the debit spread, though, here's how that works. This is just an example here. So who is paying? Sorry about that. So for debit spread, let's just down here to, whoops, sorry about that. Let's go down here to we'll just do the 130 so you saw the $5 wide spread. So for the debit spread, you are actually going to be selling the option and buying one that is cheaper. Okay, so in order to have that make sense, it's basically like you are on the other side of the trade. Okay, we're all used to buying options, or if you're not, that's okay. If you're used to buying options, you know that you buy it and then you want to sell it for more than what you paid. So if you were to, for example, buy one of these calls, I don't know, up here, like if you bought this 145 call for 160, you want to sell that for more than $1.60, right? So what happens if Apple decides to just trade sideways? What's going to happen to this call that you spent $160 on? And you're just sitting there waiting and waiting for a couple of weeks, and it's still sideways. Maybe it's kind of, fluctuating here and there. It's not really like, flying downwards. It's just kind of like it starts trading in a range. I think we've all seen that when a stock starts trading in a range, and you're just kind of like, oh my gosh, when is it going to break through resistance so we can, get our money, we can be happy, whatever. Well, when a stock is trading sideways or in a small range and you're in a long call, for example, or a long put, you're somewhere out of the money that's far away from where the stock is. Your strike is up here, the stock is trading here. Your strike is up here, or it's way down here, it's trading here. As time goes on, this option and all of the options, really, they're going to lose value. If you're trading in this small range and your strike is up here or way down here, this is going to lose value. If you are familiar with the Greeks at all, or if you've been through the PBU educational section that we provide, that's included with your membership, then you know about the theta decay. Okay, so this value is basically telling you that for every day that passes, no matter what is going on with the stock, you're going to lose, about six to $7. And this value keeps going up. It keeps ramping up as time goes on. This value is going to keep going up. So for every day that passes, you might lose $6 this day, you might lose $7 next day, then 8, 10, 12. It's just going to keep going on. So you're trading in this range. It's going to get really frustrating when your options just losing value, even though the stock really isn't it's not going in your favor, but it's not really like dying off. You're just waiting for it to break through. So if it's trading in this range, you're going to get frustrated. I've been there. I've seen it happen. So we want to take advantage of that. Instead of being the one that's buying this option and sitting there and losing value, just like what's going on, we're losing value every day. We want to be on the other side of it. We want to be the one that sells somebody else this option, and we want to be the one that's like, oh, we're gaining every day because we sold something. All right. So we're gonna, if you're buying the option, you want to buy low and then sell high, right? So when you're selling, you want to be on the other side. You want to sell high and then buy back when it's low. All right. So it's essentially the opposite, but it's very similar. Um, so we'll go down here. We'll say we're still bullish or neutral on Apple. First, just an example right now, but we do provide these alerts in the premium section. So we're just gonna say, we'll say that we'll say 128. So we don't think that Apple's going to go to 128. Maybe it kind of comes back down to that 130 area, but let's say we're planning on holding this. A lot of times, like Bull was saying before, a lot of times when we are on the seller side of the option, we do want to go ahead and take take those profits whenever they're there, because if they're staring you in the face and you've already made 50 or more percent of your maximum gain and you still have lots of time on it, go ahead and take that. Okay. So because you can always re-enter the trade. You don't, it's not like you can just, you have to buy it back and then, oh, the trade's over, I can't ever get it. Well, you can always just get back in it. It's fine. So let's just say we want to sell this put. Okay, so somebody out there thinks that Apple's going to come way back down here, right? So I know somebody out there thinks that. So um, otherwise, we wouldn't have, open interest. I bet this one's higher. Yeah, there we go. See, there's a lot of people out there that think that Apple is going to come down to this 130s area, or these people have bought it because they're trying to protect their but I'll fix it. There we go. Hold on a second. Sorry, I'm trying to YouTube. Oh, it should come. Did that come back, Jay? Somebody let me know that the YouTube was messed up. It should be back on. All right, got that. So, like I said, if you're just selling this just straight away, buff. Did it come back? Okay, thanks. All right. So if you're just selling this just by itself, you're going to need to put up a bunch of collateral. Okay, but this is going to not only protect that, and you're not going to have to put up that much collateral. The only amount you're going to have to put up is the width of the strikes. That's something that you always want to keep in mind. Width of the strikes. That's really important because that's how I calculate the amount, the percentage gain. I always calculate it based on what you're putting up. Like what's your total risk there. So, but the bad thing is, I guess the downside, not really bad, but just the downside of this is, even though you don't have the $12,800 to put up to sell this by itself, like you would for just a cash secured put, a regular cash secured put, like the types of passive income that Bull was talking about a little bit. I would kind of argue in a way that it's actually a little more risky because the collateral that you're putting up for this trade just to sell this option by itself, you're risking it, but you're not really risking it because let's say that Apple comes down to 127. Let's just say it does on this expiration date. You've sold this and you've done absolutely nothing since then. Let's just pretend. Okay. So Apple's trading at 127. You're just assigned the shares at 128 a share. All right. So yeah, you risked $12,800 to buy 100 shares of Apple, but you got something in return. You got to purchase the shares. Okay. You didn't because you're holding on to the shares. And let's say you did sell it at $2, and then it ends up being $200. So it's $2 per share is what that means. So $2 per share. Apple's trading at 127 at that point. We're just hypothetical. You really you actually still made money on the because you collected this premium. You're buying them at 128, even if they are trading at 127. Yeah, you're out $1 per share here, but you gain $2 per share here. Okay. So you're actually still in the green if that were to happen, if that particular scenario happened. I'm not saying it is. I'm just kind of just touching on, what makes that trade make sense and why doesn't make sense. So for a spread, this is it's hard to explain, but I got it. It's hard to explain in that, you're putting up less money, but it's not necessarily less risk, if that makes sense, because your risk for just a naked put, cash secured put, the risk is just you have to be okay with being assigned the shares because you're going to get that in return if the trade doesn't go your way. But when you're opening a spread, you don't get that in return because this is your collateral. This put right here is your collateral. So if Apple were to plummet down to here, you're going to lose the width of the strikes minus the credit received, which is the amount that you're putting up for the trade. Okay, so it'll say right here, what your max loss is, what your profit is. So you're putting up approximately $157 for this trade with your max profit at 43. So your break even is going to be somewhere between 127.57. So it's going to be in between these, obviously. But at the same time, when looking at the chart, we see that this kind of trade makes sense at this point. At this point, this trade makes sense. So this would be one that, you know, this is the kind of trade that we alert in the premium section. So something that makes sense. It's got a little bit of time on it. It's not going to require a lot of babysitting. It's not something like, oh my gosh, it's buying, because all options have an expiration date, and that's what makes them so different than just buying equities, because you're trading this, but you cannot trade it after the expiration date. And as the expiration date approaches and it gets closer and closer, your implied volatility is going to increase. It's going to become more volatile. If there are catalysts involved, that's going to mess with the implied volatility. And as Bull was talking about a little earlier about the Vega Greek, there are lots of Greeks involved. I'm not going to go over them, but we do go over those in the PBU section of the server, and those classes are free, and along with your membership. And I mean, it's just a really great way to learn about options and see if this kind of trading is for you. But yeah, does anyone have any questions so far? So I'm just kind of touching on what we go over in the premium section. Am I still on? Because I don't know. I'm looking at so many different screens right now. I think it's still on, yeah. Okay. I think a lot of people are deleting. All right. So with the credit spread, you're basically on the other side of the spreads. So you remember how we were talking about that debit spread earlier with the calls on Apple? So we paid, I think, if we open that one, I think we paid about $150 for a $5 wide spread. So if you were on the other side of that, you would be selling that call credit. So if you were thinking that Apple wasn't going to reach that point, you could sell something up here. So Apple's trading like this. Yeah. So it's kind of like if you can make it pretty simple. If you just, draw it out and you see what looks safe, the safe strikes, is it going to come way up here? Is it going to do whatever? Well, it might not. Let me move this over. So, you could look at this and be like, well, it's probably not going to hit this. Well, it might. So even if you are really far out the money, you have to make sure that you keep in mind these catalysts and stuff. And we're never gonna tell you to hold something through an earnings play. If we know that earnings are coming up, we're not going to have you hold through an earnings play unless we completely specify, hey, this is a lotto, which like lotto meaning like a lottery. So it's like hit or miss. You have to make sure that if you're entering a play that's catalyst, you are okay with losing whatever you put in. And that's actually, why I kind of like the spreads version of, calls and puts, instead of just like, let's say, for example, let's go to this week's expiration and see, these are super, super risky. So let's just say that, and the reason I'm staying on Apple is just because my computer's been freezing and I don't want to type in something else and have it freeze again. So I'm just going to stay on this option chain here. So let's just say Apple's catalyst is coming up, tonight or tomorrow. First of all of these, but let's just go with it for right now. Let's just say it's coming up, or there's something, there's a big move. You see how this percent change from, a $6 move from yesterday? This is huge. But at the same time, would you really have bought this yesterday, seeing how things were going? Probably not. It was kind of iffy. We didn't know if it was going to, bounce off of that or not. So, it did, but that could have been just anything. That could have been like an indecision candle. Well, it did come back up, but we're still really not quite there. But it is looking promising. but I'm not sure if it's, rocket back up to here, for example, like it was on, last week. Let's just, for the fun of it, let's just say we think it is. If it does go up to 141 tomorrow, for example, not saying it will, probably won't. Let's just say we think it is, or Apple has a catalyst, whatever. Oh, you don't see it? You don't see the option chains? I'm just talking for no reason. Uh-oh. Hold on. I'm so sorry. Okay, it's on YouTube, so I'm not sure. Is it not on Discord? Oh my gosh, really? Still? Let me change it. Let me make sure it's doing it. Sorry about that, everybody. Oh, it's on YouTube, not on Discord. I must have shared wrong. Oh, I apologize for that. It must have been when it froze. I'm so sorry about that if you weren't seeing this. So yeah, here we go. So can we see it now? Okay. Okay. Thanks for letting me know. I apologize for that. Yeah. If you're in Discord, you might be a little confused. So you can go back and look at the stream because I have it recorded. So if there's something that you missed because you had no idea what I was talking about this entire time that I was pointing this out, I am so sorry, everybody. I thought you could see this entire time. So if you want to go back and watch it, that's totally fine. I have it recorded, so you can just like scroll to that part and you can see what I'm talking about because I'm just kind of yeah, that's okay. I'm sorry about that. I hit application instead of screen, so that was my fault. Anyway, so um, okay, so as I was saying, so Apple did, I will come back here. So we did bounce off the support, like I was saying. So if you got in one of these calls, these really risky same week calls, like we call them weekly option calls. If you were to have gotten just in one of these calls, yeah, you would be up quite a bit. But think about it. Would you really have gotten into, an Apple call that was $7 out of the money one day, you know, or 2 days rather before it expires? Actually, 3 days before it expires. Probably not. I don't think I would have. I definitely wouldn't have alerted that unless it was, lotto, just like we were talking about earlier for like an earnings report coming out or um, any kind of catalyst or maybe their competitor has something or something coming out. There's a lot of things going on where you would want to buy something, just a cheap one for a lot of, like, for example, this 137 call, yesterday's low was 27 cents. Would you spend $27 on a lotto? Maybe. To get the high of 136, yeah, you might, especially when the implied volatility is low. But there wasn't a catalyst here, so the implied volatility stayed low. So you could buy one of these, like right now, if you really thought that Apple was going to start this, massive Santa rally bull run right now. But would you really? It's like it's low risk in that it's low capital, but at the same time, it's higher risk in that it really has to make a strong, significant move to the upside for this to even profit. Because as I was saying earlier, we had this theta decay going on, and we have a really low delta. So if you are a premium member or you're thinking about becoming a premium member and you have no idea what these Greeks mean, we have all that covered. So, oh, please tell me it's still on because okay, I thought I saw. Okay, so yeah, so if you have no idea what these Greeks mean and you're a premium member, you're thinking about becoming a premium member, you don't have to worry because we have the PBU section with all of this information. It's like classes for 3 months, I believe. They're interactive live classes with quizzes and all kinds of things. After that, we have a Penny Boys Advanced section. So you can keep learning things like these spreads that I was touching on a little bit. And you can really, really get a feel for how these options move, and what's gonna cause these options to move. What actually are you buying? Like, what does this even mean? A 140 call, what does that mean? You know, oh, it just means I think it's going to go up. It's going to make money. Well, not really. This actually means that if you're buying this for this week, it's just by the time this expires, you're going to have the right, but not the obligation to buy uh, 100 shares of Apple stock for 140 a share. So it's like, that's why these are so cheap, because, do you really want that? Probably not. But, at the same time, yes, that's what it technically means, but we still buy options out of the money all the time and make tons of money just on quick gains. If you've been like watching Amy's channel or Lee's channel with the day trades, you can make 50% on your money in just a matter of minutes or more. A lot of times it's more. So, but if aren't really sure about that, you don't really have a lot of experience, or you're, kind of about, these risky in and out plays, that's why I tend to prefer the spreads. It's kind of, it lowers your cost basis. And at the same time, if it's something that, um, that you're not sure if it's completely bullish or completely bearish, if it's just kind of neutral, you can always open a credit spread and do the selling. So you are going to be the one on the other side doing the selling, and you don't really have to worry about, oh, it's going the wrong way, it's going whatever. As long as it's staying within whatever channel that you think, or if it's going, the direction that you want. So it's like a neutral bullish play or neutral bearish play, you can do a credit spread. If it's still just a regular bullish play or a regular bearish play, you can do a debit spread. But with a debit spread, remember that if it does stay neutral, you can still lose money on that. Likewise, with the credit spread, you can make money on it, or you can lose money on that if it does go against you. And if it stays against you, blows past your strikes, you need to, make sure you check out your expiration date, make sure you still have time on it for that to recover, or you can always roll those out to another expiration date, potentially different strikes. And if you're in the premium section and you take one of those plays, we do, guide you on what we're personally doing. It's not really a recommendation. It's just saying, this is what I'm doing, but we will tell you what we're doing, how we're doing it. So if you want to follow those plays, it's totally up to you. But we have been really, really successful with a lot of these spreads plays in the premium section, and there's going to be more to come for the next month and so on for the whole next year. A lot of changes are coming to the server. If you're already a premium member, then that's going to be even better, especially for dividing out the different types of plays that we have. We have so many different types of options plays in the server. We have spreads plays. We have like what Bull was talking about, the passive income side of options. We have a lot of day trades. We have a lot of just regular swing trades. They don't have to be spreads. They can be regular options. So if you have a cash account, you can still trade just the regular options, the regular calls, the regular puts. But if you're looking for something that you can trade on a margin account, if you have level 3 options enabled, and you're looking for something that maybe is a little bit slower moving, or something that's geared more towards a smaller account, that you don't have to have a lot of money to enter these plays, then you can look into these spreads, because we're going to be learning a lot more of these. We're going to have a lot of different types of options plays. And let me see if I can get this up here, because this is one of my favorite things to show. If my computer doesn't freeze, if it does, I'm so sorry, but I'll just show you this before I get off of here. If it'll open. If it doesn't, then oh well. It doesn't look like it's wanting to open. Oh, here it comes. Okay. Give it just a second. I'm sorry. Maybe it's not going to open, but anyway, it's fine. It doesn't matter. But yeah, so a lot of these, oh, actually, let me show you one more thing, just really quick. So, since we're nearing the end of December, let's just say, let me look at the chart real quick. All right. Hmm. Okay, let's say by the end of the year, we do expect Apple to come up to this, maybe not quite up to here, but we do kind of expect it to come back to where it was last Thursday. Let's say we do kind of expect it to be in this range here, like right from the bottom of that to the top of that. So, in the low 140s range. Let's say that we are expecting that. And let me get this back up here. Where did it go? There it is. Okay. Let's say that we are expecting it to get to that level within the next like couple of weeks. Okay, so let's see. So I'll just show you a quick example of what something we can do here. Right. So I said about 140. Okay, so we'll do this. Let's try this. Okay, I'll tell you what I'm doing in just a second. So let's say we want to do like a January call about, let's see, we could do 145, 146. Okay. So, okay. I just have this. Don't do any more about that right now. So let's say, the first week of January, I expect Apple to be around 145. Okay. But I don't really want to pay $53. Okay. Look at this. You can sell a closer expiration and get some of that credit back. So you're actually reducing your cost just by selling one that's a little closer an expiration. So that's another way that we're reducing our cost basis. So instead of 54, we're only paying 39. That was just a random example. This is not a recommendation necessarily. I'm just looking around. So I like doing these for earnings plays usually. If something has a really, really high implied volatility for that week, like let's say if something had earnings coming up this week, like tonight or tomorrow. So this week's expiration that expires on the 23rd, those are going to have really, really high implied volatility, right? Because there's a big move expected. Usually, if there's a pretty big move expected, the implied volatility is going to greatly increase the week that those options expire during that week of the earnings play, the earnings report. Sorry. So this one would probably, if this was one of those particular plays, and let's just say that it was, this one would actually be a lot higher. This one would cost a lot more because this implied volatility, they're usually, if something's about to report earnings, this could be pushing 100, usually sometimes even way more than that. So as Bull was saying a little bit about Vega and implied volatility, then if you listen to a little bit of that, then you already know how this is related to this. And you could see just by doing a little bit of math in your head how much that this would be worth if, for example, this was the upcoming week and this was the option we were looking at, expecting a big move. So I like playing these if I'm expecting a certain kind of move, and but I expect it to kind of be right below that. So if I'm just using this as an example. If I expected Apple to go to around 142, I might sell this one that has, a beefed up premium where, there's a big expected move, but I don't expect it to quite go that high. It's still going to be like, the premium's going to be really inflated because of implied volatility and because of, just the volatility of this option. The Vega is going to cause this option to be completely inflated. Once the expected move is over, the implied volatility comes back down. That's the term we use, like IV crush. This one gets IV crush, but you're still holding a longer call that has, a longer expiration, that has more time on it. So this one will increase a lot more. This one will decrease, and you'll actually make more money than you would if you would have just bought this straight away. So that's something that I like to do for earnings, or for something where I'm expected the move to take a lot longer. you could sell something that's closer to the current expiration and buy something that's farther out. But those are more in depth that we go through on the Penny Boys Advance. But my time is about to come to a close, so I will. If there's any other questions or anything, I'll go ahead and take those. Otherwise, getting ready to turn that back over to the next person. I think is Jay for crypto. Yeah, it is a neat earning strategy. I've called out a few of those calendar spreads before. They are pretty neat, but I haven't done an earnings play in a while because I took some time off and coming back, uh, but next year definitely. I love that earning strategy. It's one of my favorites. So if anyone has any questions, go ahead and ask. If not, then I think I'm going to go ahead and turn this over to Jay for the crypto section. Okay. If Jay's here, then I'll go ahead and turn this over. Yeah, you're welcome. Thanks, everybody. Bye. Hi. Thank you. Oh, okay. Jekyll's here too. Okay.